What if the global tax rate in your country no longer mattered? Because no matter where profits land, someone, somewhere, will lift them to the same floor. Imagine you're a CFO who spent a decade threading profits through a sunny island at 0%. One morning, a notice arrives. Top-up tax due. Not at home, not on the island, but in multiple countries that say, if they won't collect, we will. The game didn't end. The board changed. This is Dollar's Dance, in which we rig the money with simple stories to reveal the truth, and it's all about money. Today, the future of global tax. Are we watching a new order being born? Let's rewind to understand why this moment feels different. For 40 years, countries competed to attract companies with one simple lever: cut the corporate tax rate. The average headline rate fell from roughly 40% in the 1980s to the low 20s today. Meanwhile, profits learned how to teleport. Intangibles, patents, algorithms, brand names, don't weigh anything, but they soak up most value. So profits went where taxes were light, even if factories and customers were somewhere else. You've heard the nicknames: Double Irish, Dutch Sandwich. You've seen the leaks: LuxLeaks, Panama Papers, Paradise Papers. It wasn't always illegal, it was a design flaw. Countries fought over slices of a pie that had learned to slide off the plate. Politically, the bill came due. Voters looked at billion-dollar companies paying single-digit tax rates and asked a fair question: how? Finance ministers needed an answer that didn't require building moats around every border. Enter the OECD's two-pillar plan: less a law, more a blueprint. 140-plus countries have agreed in principle to use. Pillar 1 tries to rewrite where big digital-era profits are taxed. Less in the place where companies declare their headquarters, more in the places where customers actually live and click. It's aimed at the giants, only the very largest by revenue and profit, and it has been hard to finalize. Countries that already imposed digital service taxes said, either we get a deal or we'll go our own way. For now, the truce holds, but it's fragile. Pillar 2 is the part changing the game right now. It nails a brass plaque to the floor: a 15% effective minimum corporate tax, calculated country by country, for groups with global revenues above about $750 million. It's not a new global tax collected in Paris or New York. It is a set of rules that let one country collect the difference if another country doesn't buy to. Here's the simple version of those rules. First, you calculate a multinational's effective tax rate in each country using a standardized formula, not just the headline rate. If it's below 15%, a top-up tax applies to bring it up to 15%. Who collects? The home country of the parent can take it under the income inclusion rule. If they don't, other countries where the group operates can grab it under the Undertaxed Profits Rule. And if the low-tax country itself wants the revenue, it can impose a qualified domestic minimum top-up tax and keep the money at home. Think of profits crossing borders like travelers. Each border now has a checkpoint. If your tax passport says 13%, someone stamps it up to 15% before you pass. Several major economies have already switched this on or are phasing it in. Others are lining up. The United States hasn't aligned its rules yet. That's the wild card. But the whole design anticipates holdouts. That's why the backstops exist. Two details matter more than the jargon. There's a substance carve-out. A slice of income tied to real payroll and physical assets is excluded from the top-up. Bigger at first, shrinking over time. If you build things and employ people, you get some relief. Purely paper profits get less love. The rules treat tax credits differently. Qualified refundable credits are treated like income, not a tax reduction. That matters because it nudges countries away from old-school tax holidays and towards subsidies that pay out in cash. You can feel the next game forming. The race to the bottom wasn't abolished. It's being rerouted, away from rate cuts and toward industrial policy. If all of that feels abstract, put yourself back in the CFO chair. Yesterday, you booked most profits to an island at 0%. Your effective rate there was 0%. Under the new rules, the island can install its own 15% domestic top-up tax and keep the revenue. If it refuses, your home country or your largest markets can collect the difference. Either way, your effective rate in that country slot goes to 15%. You can still choose where to operate. You just can't choose a hole in the floor. So is the race to the bottom over? Not exactly. The track is changing. Countries that built their model on zero corporate tax are reinventing themselves as onshore havens at 15% with generous subsidies, fast approvals, and real talent pools. Rich countries are steering competition into credits and grants, green energy, chips, AI. Under the new math, cash-like credits travel better than deductions. Expect more of them. Developing countries pushed hard for a tool of their own, the subject to tax rule. It lets them impose or raise withholding taxes to 9% on certain payments like interest and royalties sent to related parties in low-tax places. For resource-strapped tax administrations, that's simpler to enforce than arguing about where a patent really lives. There's a second front opening alongside the minimum. Borders are learning to tax carbon. The European Union's carbon border adjustment mechanism is a mouthful. It's also a map of the future. If your steel, cement, or fertilizer is made with higher emissions, you'll pay a charge at the EU border, roughly equal to the carbon price EU producers face. It's sold as climate policy, but at the customs line it looks and feels like a tax. Other blocs are watching. A carbon club of countries with compatible rules would turn emissions into a trade variable just like tariffs. The old border taxed price. The new border will tax process. Inside the border, tax is going real time. E-invoicing and instant reporting are becoming the norm. Brazil, India, parts of Europe. The goal is simple. Close the VAT gap, catch fraud, and make evasion harder by shrinking the time between a sale and the tax authority seeing it. Add the emerging crypto reporting standards, the OECD's crypto asset reporting framework, Europe's DAC-8, new broker reporting in the US, and the invisible money is getting less invisible. Tax used to be a once-a-year conversation with your accountant. It's becoming a stream of data that never stops. None of this means harmony is guaranteed. 3 paths lie ahead. Path 1, convergence. Most large economies implement the 15% minimum. Pillar 1 finally lands in a simplified form that reallocates a slice of giant profits to the markets they serve. The truce on digital taxes holds. Carbon border rules spread and start to align. The UN gains a bigger role, giving developing countries more voice alongside the OECD. In this world, corporate effective tax rates cluster near the floor, but the real competition shifts to who writes the best credits, builds the best talent base, and designs the cleanest, fastest tax administration. Path 2, patchwork. Some big players don't align. The Undertaxed Profits Rule kicks in, and countries start collecting each other's missed taxes. Trade tensions flare as digital service taxes reappear and retaliatory tariffs threaten. Multinationals juggle dueling definitions of effective rate. The floor exists, but the tiles don't line up, and every step is a compliance fee. Path 3, leapfrog. The floor holds, but the frontier jumps. Withholding taxes grow on cross-border services. E-invoicing and payment rails blend, letting governments collect automatically at the moment of sale. Central bank digital currencies and private payment networks embed tax rules in code. A tiny slice of every transaction routes directly to the Treasury. It's not science fiction. Pilot projects exist. The question is not if, but how far, how fast, and who governs the data? Who wins and who loses in a new order? Winners. Countries with rule of law, skilled workers, and clear incentives rather than mystery rulings. Their pitch shifts from we're cheaper to we're predictable. Companies with real operations, not just PO boxes, benefit from the substance carve-out. Sectors tied to targeted credits, renewables, batteries, semiconductors, ride a wave of state-backed demand. Losers, business models built on pure tax arbitrage, places that relied on opacity rather than services. CFOs who treat tax as something to be managed at year-end rather than designed into where the company hires, builds, and invents. And a twist. The minimum rate doesn't close every gap. Effective rates still vary by industry and by the mix of credits, losses, and timing. Developing countries will need real capacity, people, and systems to use the tools on offer. That's why the next political fight is also about who writes the rules. The OECD has led for decades. Many in the Global South want the UN to lead a convention that reflects their priorities, not just those of capital exporters. That negotiation has begun. Watch it. What does this mean if you're not a tax lawyer? If you're an investor, read the footnotes again. The effective tax rate, the country mix of profits, and the nature of credits matter more than the headline statutory rate. A company trumpeting a 10% rate in a 15% world is telling you there's a top-up coming or a subsidy you should understand. If you're a citizen, expect fewer corporate tax cuts and campaign speeches and more industrial policy. We'll pay you to build here. That money has to come from somewhere. The floor makes the trade-offs clearer. If you're a founder, the cheapest tax strategy will be to put people and assets where you sell and build, then use the credits on offer. You'll spend less time hunting islands and more time hunting grants. Boring? Maybe. Safer? Probably. A few signposts to watch that will tell you which path we're on. Pillar 2, adoption maps. How many countries collected domestic top-up? When does the backstop rule kick in? If you see the floor in 30 plus major economies, the game is largely set. The fate of Pillar 1 and digital taxes. A simple reallocation deal means fewer trade fights. A breakdown means tariffs and tech taxes are back. Carbon border rules. If a carbon club forms, emissions become a line on your import bill. That's tax, by another name. The UN versus OECD tug of war. A UN convention would tilt the agenda toward developing countries' more source-based taxing rights, simpler rules, bigger capacity building, data rails, e-invoicing mandates, crypto reporting, and payment tax integrations tell you how always on your future will feel. So, are we entering a new order? Yes, but not the one you might imagine. This isn't a single world tax collected from a control room in Paris. It's a floor, enforced everywhere by everyone, that turns tax competition from cutting rates to writing rules. The border moves from the map to the balance sheet. The passport is your effective rate. The visas are your credits. And the customs officer is an algorithm that never sleeps. You can love that or hate it, but you can't ignore it. Because when the floor rises under every multinational at once, the ceiling on what countries can do with tax breaks lowers. The action shifts to what really builds value: people, power, ideas, and yes, policy. If this gave you a clearer way to read the headlines behind the numbers, subscribe. History has the answers. I'll show you where to look.